Hello learners, welcome to this another class on leverage analysis. In the previous class, we discussed about operating leverage. Operating leverage originates from component of fixed cost element in the total operating cost. That means to say a company having larger proportion of fixed cost in its total operating cost is subject to high operating leverage, high operating risk. And vice versa is also true. A company having low component of fixed operating cost in the total operating cost is subject to low operating risk and will have low degree of operating leverage. So under operating leverage, we understood the relationship between sales and operating profit, that is EBIT. And we learned that how changes in sales are correlated with the change in EBIT, or we can say how changes in EBIT are affected by change in sales volume. And that is the role of operating leverage. But today we will learn about rest of the two leverage, financial leverage and combined leverage. Financial leverage. Financial leverage originates from the use of fixed charge sources of finance like bonds, debentures in the capital structure. As you know, capital structure means composition of long-term sources of finance used by a company to finance its activities and assets. A company can have either unleveraged capital structure or leveraged capital structure. Now, when do we say a company has unleveraged capital structure and company might have leveraged capital structure? The point is simple. When company is not engaging the use of bonds, debentures or preference shares, the capital structure is purely unleveraged, 100% financing by equity financing. Whereas the moment company uses bonds, debentures or preference shares or both of these along with the equity funding, we say capital structure will be leveraged one. Now in this particular video, we will be talking about financial leverage with reference to use of debentures or bonds in the capital structure. Now, it is like double-edged weapon. Now, why do we say double-edged weapon? जिसको बोलते हैं दो धारी तलवार. So, double-edged weapon means if situation is favorable, then yes, it will have positive impact on the earning for shareholders. Whereas if situation is not favorable, it will have negative multiplier effect on the earning of shareholders. Ultimately, company is to earn something or greater things for the shareholders, because shareholders are the owner of the company and they assume the risk. So, operating leverage is double-edged weapon. Now we say in this we study the relationship between EBIT and EPS. That means to say how EPS will respond to every 1% change in EBIT. Again, we will define DFL, degree of financial leverage. But yes, under financial leverage, we are making a direct relationship between EBIT and EPS. You can say instead of EPS, it may be return on equity also. Meaning is the same. Financial leverage is favorable when increase in EBIT has positive multiplier effect or positive magnifying effect on EPS or return on equity. Whereas financial leverage will have negative magnifying effect or negative multiplier effect on EPS when EBIT decreases. Now point comes, whenever a company has to decide capital structure, what should be the capital structure? There are many factors. We will see those factors under capital structure chapter. But yes, right now simple point. Top management has to decide whether my capital structure should be with zero leverage, medium leverage or high leverage. It is up to the top level management, number one. Now, top level management needs some input for decision making, and that input is future prediction about sales, future prediction about change in sales on the EBIT. That means to say, if we say that a company is likely to have larger increase in EBIT, it can sustain more return on investment, ROI, larger ROI, then definitely it can go for the leveraged capital structure. On the other hand, company thinks that in the near future or in the distant future, it will not be able to capture good market share. It will not be able to reach to the desired level of operating profit. Then definitely company can think of keeping the financial leverage low. That means leverage can be kept at a low level. But yes, finally, it is the risk-taking capacity of the management. Generally, we say higher the risk, higher the return, lower the risk, lower the return. But yes, so both the things blended together, ideology and thinking of the management and the prediction about operating profit will help a management to decide whether my capital structure should be leveraged one or unleveraged one. High leverage or low leverage, all is dependent upon ideology as well as prediction. Now, we always say under financial leverage, we can think of ROI, ROE analysis also. This is a simple point. If ROI is likely to be high, then definitely ROE has to be high or will be high. But in between, if suppose we understand ROI keeps on declining, it will have negative impact on ROE. ROI stands for return on investment, whereas ROE stands for return on equity. The formula for ROI, I'll give you, because sometimes in examination numerical it might be required. For the purpose of leverage analysis, we have a best formula for ROI, EBIT upon total assets times 100. So we will be simply calculating ROI like this. And how do we calculate ROE? ROE is earning after tax minus preference dividend divided by equity owners shareholders net worth. Equity owner net worth. Equity owners net worth. So that is our ROE formula. Definitely multiplied by 100 will give you answer in percentage. So now ROI, ROE analysis means what? In general, if my ROI is likely to be high, I can afford high level of financial leverage and my ROE will be multiplying at a faster pace. Whereas if ROE is likely to be low, I cannot afford high level of financial leverage because it will have negative impact on my ROE. And let us understand that. If suppose your ROI is likely to be 20%, it means whatever is your total investment in assets, whether financed from whatever sources, assets are likely to generate 20% operating profit. So we can simply now use this tool also. If I say total investment in assets is 2000 crore, then what will be your EBIT? 20% of 2000 crore, that is 400 crore. So 20% ROI means we can afford a leverage in which my before tax cost of the preference is below 20% or less than 20%. Suppose the same company goes in for taking a loan from a bank or issues the bonds with 12% interest on the bonds, before tax interest, then definitely on every 100 rupee borrowed from the bonds or used out of the bonds, how much return is being generated? 20%. But we are paying only 12% to the bondholders. So remaining 8% will be going to the pocket of equity shareholders. Of course, company will pay tax, that's not a problem. But yes, it will have positive impact on ROE. On the other hand, the same company is having ROI 20%, but it has to pay 22% on the bonds. They take a loan and on that they pay 22%. Then definitely, because interest on loan or bond is must to be paid, whether you earn something or not. Then from where this extra 2% will come? It will eat up earning of the equity shareholders. So now in this case, since we are earning 20% and paying 22% as interest, so rather capital of the equity owners will be eaten away. So that is how it will have negative impact on the earning of equity shareholders. So that is what ROI, ROE analysis is. So that is why we say financial leverage is like double-edged weapon. It can have positive impact or negative impact. Use it judiciously, carefully. Now, how do we make a measurement of the degree of operating leverage? And who will use that? Obviously, operating level management has nothing to do with the capital structure. Even the middle level management, who is at execution level, has nothing to do with the decision whether we should borrow the money or not. It is the top level management. So strategic planning, strategic decision will be there. Yes, whether we go for the leverage or not. So degree of financial leverage will be used by top level management. So DFL refers to the percentage change. Obviously, it is percentage change. Percentage change in EPS for every 1% change in EBIT from the given level of EBIT. That means to say, for every level of EBIT, there will be separate DFL, degree of financial leverage. And instead of EPS, you can also use, ROE also. There's no doubt. Because ultimately, ROE and EPS indicate towards the earning for equity shareholders. Now, it can be calculated, that is DFL can be calculated, degree of financial leverage. In short, we call it as DFL. EBIT upon EBT, it will be EBT, interest will not be there. EBIT upon EBT, EBIT upon EBT. Now, change in EPS can also be calculated or predicted. Simply percentage change in EBIT times DFL. Percentage change in EBIT times DFL. For example, at a given level of EBIT, our DFL is 2.20. It means from that level, if my EBIT changes by 1%, for every 1% change in EBIT, EPS will change by 2.2%. So suppose from that level, change in EBIT is 17% positive. Then by how much percent my EPS will change? So 17 positive multiplied by 2.2, we get it 37.4%. 37.4%. And if it is negative 17%, then it will be negative. If it is negative 17%, it will be negative 37.4% change in the EPS from the current level or from the benchmark or given level. So this is the way DFL can be used. Now we can see an example on the DFL also. Both firm A and firm B have base EBIT of 50,000. Show the effect of financial leverage when EBIT changes by 50% and 100% from the base case. Firm A is unleveraged, firm B is leveraged. Unleveraged means 100% financing through equity, that is equity owners funds. In this case, we have 10,000 equity shares of 10 each, whereas firm B is leveraged 5,000 equity shares of 10 each and 20% debt, that is bonds or debenture of 50,000 rupees. Now, if we see the solution for that, so we have to show it if things change by negative 50% and positive 100%. So this is firm A, which is unleveraged firm. In an unleveraged firm, our debt is 0. So when debt is 0, there is no interest payment. We will calculate base case first. We are given base EBIT 50,000. Since there is no debt, so whatever may be the case, up case or down case, interest component will remain 0. Interest component will remain 0. So finally, whatever is EBIT, same is EBT. And remember, if there is no debt financing, then DFL will be 1. And that 1 DFL means from the given level of EBIT, if EBIT changes by 1%, EPS will also change by 1%. And you can see, we have, now we proceed further. we get EBT. Tax, so tax, let us assume both the companies are paying 30% tax. We have earning after tax. Now what do we get? EBIT upon EBT, so it will be 1. So in between we have calculated EPS also. So formula of EPS is earning after tax upon number of equity shares. So you can remember that formula. Sometimes it is not given in the examination. You have to calculate EPS also. So earning after tax divided by number of equity shares. Since there was no preference earning, so we take the preference dividend to be 0. So EPS at each level we have calculated, but DFL at all the 3 is 1 because there is no debt. So DFL formula is simple, EBIT upon EBT, that will be there. Now at the base case we get DFL 1. It simply means from the given level, if EBIT changes by 50% on the upside, then EPS will change by 50% upside. Now what we are given? We are given up 100%, down 50%. That means from this case, how much will be the percentage change in EPS? So for this case will be plus 100 multiplied by 1, that is 100%. For this case it will be minus 50 multiplied by 1, that is minus 50%. Minus 50%. So that is how we can see now. At case 1 also we have EPS. EPS calculation is the same mechanism. How much is EPS? 7. So from 3.5 it becomes 7, 100% jump. At this level my EPS is 1.75. How it comes? 25,000 is your EBIT because EBIT is declining by 50%. There is no interest, so EBT remains same, 25,000. We get tax 30%. Even if tax is not there, that yes, we have to assume it. So my earning after tax is 17,500. Number of shares are 10,000, so I get EPS 1.75. And finally, we can see EPS has declined by 50% because with 0 leverage, 0 debt, my DFL is 1. So that is for the firm A. So it was having no leverage, unleveraged firm. So that is my second case, leveraged firm. If we understand the base case, we are given EBIT 50,000 and there was a debt of 50,000. On 50,000 debt, we have to pay 20% interest. So how much interest we are paying? 10,000. Now whether it is up case or down case, so it is up 100%. It is up 100% up. Now what do we get it? Whatever may be the case, whether my EBIT is rising or declining, interest payment is at a fixed percentage, fixed coupon rate is there. So 10,000 in all the cases. So EBIT minus interest, we get EBT. So under the base case, my EBT is 40,000. On this 40,000, I pay 30% tax. So 12,000. How much is left out for equity owners? 28,000. So finally we get it, 28,000, but this time number of shares have reduced, they have become half, 5,000 shares. So EPS is 5.6. You can verify the calculation, 28,000 divided by 5,000, 5.6. So at the base level, EPS is 5.6. And what is my DFL? EBIT divided by EBT, we get 1.25. So this 1.25 simply means that from this EBIT level of 50,000, if EBIT increases by 1%, for every 1% increase in EBIT, my EPS will increase by 1.25%. Now, you can see by how much percentage EBIT is increasing? 100. So your EPS will increase by 125% from the given level. So what is your EPS? The meaning is simple. 100% jump in EBIT, it will lead to 125% jump in EPS or 125% jump in ROE. Now what is your EPS at the base level? 5.6. 1.25% jump. It means it should become 12.6, and that is verified 12.6. You can see the calculation. What is my EBIT? 1 lakh. Interest will remain the same 10,000. 90,000 is EBT. On this 90,000, I am paying 30% tax. 63,000 is left out for equity owners, and there are 5,000 shares. So EPS is 12.6. So that is the way we can interpret that. So top management has to decide, if my operating profits are likely to go very high, I'll go for the high leverage, else I can go for the low leverage. And then again I told you, it is the risk bearing capacity of the management. Now you can see we have calculated DFL also at the 1 lakh level of EBIT. How much is my DFL? 1.11. So it comes like this. EBIT upon EBT. 1.11 means from this level, if sales EBIT changes by 1%, for every 1% change in EBIT, my EPS will change by 1.11%. And you can verify. From this level, by how much percentage EBIT had changed? From 1 lakh, we are coming down to 50,000, negative 50%. So negative 50% times 1.11, count on. So 50 times 1.11, we get it 55.5%. 55.5% negative. That means my 12.6 was the EPS earlier, now it becomes 5.6. So it has declined by 7 over 12.6, 55.5. You can see there is a negative 7 over 12.6. So you get it same percentage, negative 55.5%. So that is the way we interpret and calculate DFL. We were required to calculate DFL in this case also. That from the base case, if EBIT declines by 50%, so now my EBIT will be 25%, 25,000. Irrespective of that, I have to pay interest the same 10,000. And the calculation flows in the same manner, and you can see your EPS is 2.1. So 50% decline means now by how much percentage your EPS change? Negative 50 multiplied by 1.25. Because at the base level, my DFL is 1.25. So 1.25 multiplied by negative 50, so negative 62.5%. From 5.6, you have come down to 2.1. So 5.6 minus 2.1, it has declined by 3.5. 3.5 decline, we are talking from this to this, over 5.6. So 3.5 over 5.6, we get it negative 62.5%. Obviously, multiply with 100, you get answer in percentage. So this is the way we can understand the leverage. So we understood operating leverage, we understood financial leverage. Under operating leverage, we understand the relationship between sales and EBIT. Under financial leverage, we understand the relationship between, or analyze the relationship between EBIT and EPS. Now, what is left out? Combined leverage. That means combined impact of both the leverages. Combined impact of fixed operating cost and financing operating cost. Because interest is financing operating costs, fixed financing cost. Interest is fixed financing cost. So under combined leverage, we will be studying both the impacts. That is impact of operating leverage and impact of financial leverage. Now what is combined leverage? Or before that, you can see the previous cases also. So this was the unleveraged firm, you can see that, and this is the leveraged firm. Now combined leverage. Leverage associated with committed cost resulting from fixed assets and fixed sources of finance. That means all the three things put together: committed fixed cost, that is cost of committed facilities, committed employment and something like that, fixed assets cost, and the committed cost on source of financing, that is interest on debt. Under this, relationship between sales and EPS is studied. So degree of combined leverage will be DOL multiplied with DFL. So for example, at a particular level of sales, so DCL or DTL, degree of total leverage or degree of combined leverage, will be unique for each level of sales. So let us assume that at a given level of sales, my DOL is 1.30 and DFL is 1.70, because when sales is there, operating profit will be there. So for the same level of sales, whatever is the operating profit, we calculate DFL also. So 1.3 multiplied with 1.7, we get is 2.21. Now what this 2.21 signifies? That from the base sales level, if sales changes by 1%, EPS will change by 2.21% for every 1% change in sales. So that is combined leverage or total leverage. How do we calculate it? Calculate first the DOL, calculate DFL, product of both of these is DCL. Alternatively, instead of calculating DOL and DFL separately, we can multiply both the formula also. That means, what is the formula of DOL? This is the formula of DOL. Total contribution divided by EBIT. Multiply this formula with the formula of DFL, EBIT upon EBT. So we get it. Upon simplification, what do we get it? Total contribution upon EBT. Because EBIT will get cancelled out. So finally, DCL can be calculated like this also, and interpretation can be made like this. So in general, when both the leverages are high, combined leverage will be high, so total risk will be high. When both the leverages are low, combined leverage will be low, definitely risk will be low. So in that way, we see that leverage helps me in studying operating risk, resulting from the fact that company might or might not be able to perform in the market, might or might not be able to sell its product in the market. That is operating risk. And one factor responsible for the operating risk is presence of committed cost or presence of fixed cost in the operating cost. Another risk originates from financing side. That means whenever we use such sources of finance in which we are committed to pay the return to the money providers or funds providers, whether we earn something or not, and that source is only bonds. So that's why in this particular lesson we learnt about only financial leverage only with the debt financing. So idea is simple. Operating leverage helps me understanding the relationship between sales and operating profit, whereas financial leverage helps me studying the relationship between operating profit and EPS, or ROE we can say, return on equity, and combined impact of that tells me or helps me in analyzing impact of changes in sales on the EPS directly. But remember, for every level of sales as well as operating profit, degree of operating leverage, degree of financial leverage, and degree of combined leverage will be unique. So that is the way we study that. I hope you learned that. This much is sufficient for the leverage at your level. Thank you so much for giving me your time.